Welcome back. You're watching Big Deal, and we are discussing the budget impact on the Deal Street transactions, M&A, and our team of experts are right here to give us the technicalities. Now, Ajay, we've discussed several aspects. What about slump sale? The capital gains tax on that reduces. How is that going to impact the Deal Street, and what are we seeing now? Because slump sale has been frowned upon by the markets a lot of times in transactions, but it's also considered one of the easier ways of restructuring. What is the deal impact?
The whole capital gains regime has been simplified and rationalized. We had multiple asset classes, different period of holding, different rate of long-term capital gains tax, and when an asset would qualify as long-term, etc. They sort of, crunched that, brought it down into two, at most three different holding period, and the third one very few. So it's either 12 or 24 months, and then rate being 12.5% for most of the long-term thing, except for one single, debt mutual funds, which could go to a slab rate. Slump sale, happens sort of, it could be unintended because slump sale always had its own code, had a separate section which governed how slump sales would be taxed. And that section said that if you held a business undertaking for more than 36 months, it would become long-term capital gains. And then slump sale is essentially transferring an entire business undertaking for a lump sum consideration. Now, it still continues to be long-term. If it is above 36 months, no change there. But the long-term capital gains tax rate has been brought down from 20 to 12.5. Therefore, 12.5 applies to slump sale as well. This will be a boost because you're effectively taxing long-term capital gains on slump sale at 12.5%. You are right. This was not something that a lot of companies would do, because if you did a demerger to move an undertaking, especially listed companies, you would split and become two listed companies. And a slump sale essentially is transferring undertaking to another company for a cash or other consideration, which could be non-cash. It's easy to implement, yes, because it's just a simple transfer and you have an asset transfer or a business transfer agreement that has to be executed. I would see, depends again on the commercials, depends on what the actual deal is and how these would move. But if you're selling business undertakings to a third party, or you're selling it to unlisted companies, or you're doing internal groups, restructuring, etc., to move business around, a slump sale suddenly becomes very attractive.
Yes, and Ajay very well pointed out, because I see a lot of companies capitalizing on this low-cost, tax-efficient model of restructuring, because otherwise it can be very long haul and very, very capital-intensive and not as efficient. But markets have always frowned upon slump sales, so that needs to be seen in the capital markets. Yogesh, when we talk about the climate finance, how do you see the move by the government? But of course, it was missing in details as well. What do you see as the prospect?
I think there's a big announcement, and frankly, budgets we all recognize they are meant to be a fiscal exercise. But I think we are losing time on coming up with some emphatic changes regarding climate finance. There is an announcement that there will be a taxonomy, which is much appreciated and welcomed. But equally, I think the lack of setting up of a proper regulatory framework, the time that we are taking to come up with proper guidance on allowing different types of financing needs of climate finance and sustainability projects, particularly with respect to need for blended finance and the kind of taxonomy that would need. And this will require some time to evolve. So while very happy to welcome it, Nisha, but I do think that we need to make the next moves and move quickly regarding coming up with more detailed guidelines, and at least have some kind of a regulator who can come up with a framework on this.
A lot of frameworks are required on climate and climate-related aspects. That point taken. But I have time, very little time, and two important questions to ask. So I would request very quick answers. Amrish, the buyback issue, now that has become a very big issue in the market as well. How do you see the impact of buybacks now being taxed as dividend income? Some of the key aspects not already known.
I think the important element is that, the entire amount that will be paid and the buyback will be treated as dividend. and it is not restricted to what generally we know from a dividend perspective called accumulated profits. So I think that's the big change. Now, depending on whether you are a resident or a non-resident shareholders, you can consider it, because a non-resident may want to apply the treaty benefits depending on from which jurisdiction they come, and the rate can go as low to 5% and in most cases 10%. So it could turn out to be more important and more beneficial if one were to compare that with the enhanced long-term capital gains tax rate of almost 13.65 with all the surcharge and cess. So I think one comparison will have to be done to see which one is better in a given situation. And I think that's going to be the key when it comes to the buyback taxation. But again, it's on the whole amount versus capital gains being on the net gains being made. So I think that's the big thing.
Some clarifications are required there, Amrish. We'll keep it for next time. But Sumeet, last question to you. How is the private equity and investor class really looking at this budget? What's the feedback, very quickly?
So I'll keep that very bulleted, Nisha. One, we started the year with a very significant uptick in PE and M&A activity versus the last year, which was in consolidation year. Now, I think some of the changes that have been done on the capital gains side, the intuitive reaction would have been to see that some of the deals are becoming more expensive for private investors. But I honestly don't think that the impact is going to be anything more than incremental there. There is some of the entry valuations will price that in, some of the changes in capital gains regime. The other interesting part to me, actually, and that actually maybe I'm reading too much into it, but is there a subtle hint by the government on, is there an attempt to cool off or telling the capital markets to cool down? Because I think that's been a
I can go at length to counter that, Sumit, but that point taken, and I would make just 3 points that a large part of clean out trade has already been done by the foreign investors in the last 2 years. And after that it's coming, yes, it will impact their IRR. That's one important aspect. The second one is the fiscal prudence, and government's razor-sharp focus on that is something which is music to the ears of foreign investors, and that would add to the benefit of foreign inflows. And the third, I would say, the employment thrust is again something in future will create consumption, and foreign investors definitely will look at India with a much better and a more rosier picture from here on because of the employment thrust. Thank you so much, gentlemen, for joining. It's never enough. There's lots more to discuss, but maybe next time. Thanks so much for tuning in for all our viewers.